Good morning, everyone, and welcome to February. Thank God January's over. It was a little rough last month. We get into the market itself. Choppy is an understatement. Last week wasn't as bad as what most people thought it was. We kind of eked out a gain for the week. Earnings look pretty good. They're actually up a little bit, but the Fed is just freaking everybody out because, hey, guess what? They're going to actually increase rates and decrease the amount of money they're putting into the system. And they've only been telling us that for a year. So it seems like when we get to the real hard truth of things, by the way, they haven't done it. I mean, they started the withdrawal of the funds, the taper issue, but they haven't increased interest rates yet. And even if they do, which we expect them to do in March, 4, 5, 6, 7, I've heard now, rate hikes potentially in here. I don't know. We'll find out. It's all in the short-term rates. It looks like from a growth standpoint, the IMF came in and said there's going to be lower growth this year. No kidding. Flirting with a correction. Yeah, we've had a correction in the NASDAQ and the tech stocks. And we've had, I call this a correction in the broad market. Andy Melnick told me a long time ago, take an escalator up and an elevator down. That's pretty much what happened in January. It's a pretty quick sell-off here as we try to figure out how to reprice profits based on what the Fed wants to do and what we think the inflation number is going to look like. So we had an interesting day on Monday of last week where the Dow was down over 1,100 points in one day. So that's a record. So we've had some volatility. Jobs are actually looking pretty darn good. When you look at the indices, the Dow is probably the best here with the larger companies, value oriented generally in the Dow. So down 4%, NASDAQ down 12. There's your correction. S&P down 6.9. International is holding up just a little bit better, but volatility index above 20, 22, 25. You really have to think about some significant volatility. But on the other hand, for those contrarians out there, when it gets that high, when you see these volatility spikes, usually is an opportunity to buy. So we've used this as a chance to kind of rejigger the portfolio. We actually did some tax loss harvesting already this year. We captured some of those losses and reinvested just to make sure we're ahead of the game when it comes to taxes as best we can. So I think from an overall standpoint, yeah, it's been a rough start to the year. We still anticipate a positive return this year. In the stock market, we are suspect in the bond market, pretty flat return. We're going to have to be defensive more in the bonds, and we're going to use alternatives as best we can. We think alternatives include things like commodities, and commodities year to date have done pretty well. So stay with it. Nothing unusual happening here, just a correction after a pretty great year last year, 2 in a row. So not unusual to get kind of a pullback here. So hang in there, stick with your allocations, keep investing in the markets. We'll take it from here. Thanks. Bye-bye.